When I throw this ball, did you notice the shift to slower speed here before it comes crashing back down? The same thing happens with asset prices. So if you want to buy the dip at the lowest price here, then by monitoring the speed, you can see a shift in momentum happening here before price starts going up. And if you want to do that, then you need the best tool for the job. And I think I've found it, which is the Momentum Oscillator Harmony from MDX Trendmaster. And this thing is an absolute beast. This is it here. And if you go into the menu, the guys at TrendMaster have absolutely killed it and managed to combine 10 different momentum indicators all into one powerful tool. However, as Spider-Man would say,
with great power comes great responsibility.
And if you don't understand how to use this correctly, you'll get absolutely wrecked, lose all your money, and not have a good time. So to get the most out of it, you first need to learn how RSI and Stochastic RSI actually works to understand what powers the tool underneath, and then use it correctly to get those gains. And that's why I've put together this RSI masterclass for you guys. So what is the relative strength index? Well, high level, it's a momentum indicator developed by J. Wells Wilder Jr. in 1978. And it measures the speed and magnitude of an asset's recent price changes. Or in other words, it's trying to detect how quickly is an asset being bid up or pushed down. And it's displayed as an oscillator line graph underneath the regular candle price chart. So to calculate this, this is the RSI formula, but the key component is this relative strength part here. And you define the relative strength over a set period, which is usually 14, let's say 14 days. And the relative strength is trying to examine what is the average gain versus the average loss, which means in that period, how many candle points are being gained on the up candles versus how many points are being lost. And then calculating that as a ratio. And then the formula just plugs that in here and normalizes it so that can be plotted from 0 to 100. To make more sense of this, it's much easier to look at a real example with some real numbers. So let's jump onto the whiteboard and I will demonstrate. If you have advanced math skills, feel free to skip to the next section using the chapters below. Although hopefully you will find the demonstration I've put together here helpful to get a deeper understanding of how RSI is calculated behind the scenes, so that when you apply this on the charts, you can be more successful with your trades. So in the example here, I've plotted out the daily candles for the S&P 500 over the last 14-day look-back period, with this candle here being today's price action closing today. And then over here, I have the candle values from each day and space to do the RSI calculation, which we can then use to plot the RSI line underneath. So if we take the first example, on this candle from today, that candle opened at a value of 6,000 points. It went up to a high wick value of 6,050. Then we had a move down from there to the low of 5,690. And finally, price moved back up and it closed at the end of the day at 5,700. So the next step is to think about the average gains and losses across this period to be able to calculate the relative strength or the price momentum. And to do that, we first have to calculate the individual gains or losses of these either green up candles or red down candles. And you do that one at a time. So for that one we just looked at, if it opened at 6,000 and closed at 5,700, then the loss in that down candle is 300 points. And if you go all the way back to the beginning on the first candle 14 days ago, I've done all the calculations here. Well, if that started at 5,500 and went up to 5,600, that's had a gain of 100, right? So you could plot all those values on the chart. So that's plus 100, the next one plus 200, this one plus 150, and then for the down candles, well, that's minus 300. Let's say that's minus, I don't know, 20, minus 30, and so on. And you can calculate this for all of them. But to calculate the relative strength, we need to know the average gain or average loss. So in this case, the average gain as it pertains to this day here, you add up the gains from each of those individual up candles, and there are 9 of those, add them all together and divide by 9. Now, if you do the calculations in this example, that comes out to a value of 180 points average gain for those candles and those candles, okay? And then the average loss, if you add up the loss from these here and these here, and then divide by 5, because there are 5 down candles in the 14-day period, that comes out to a value of 60, okay? And that includes those and those. Right. Now we want to calculate the relative strength, which is the average gains divided by the average losses. So we just apply that here. So 180 divided by 60, well, that equals 3. No coincidence, the numbers are easy to work out. I might have done that. Next, we now input the relative strength number of 3 into this RSI calculation. So that is 100 minus 100 divided by 1 plus the relative strength, which is 3. Let's put that in there. And now if I work this through, that is 100 minus 100 over 4, which is 100 minus 100 over 4 is 25. And 100 minus 25 equals 75. And that is our RSI value for this candle here. And now we take that RSI value and we plot it on the RSI chart down here, which is has a y-axis from minimum of 0 and maximum of 100. So it goes just above the 70 line here, and you'd plot it on like that. Now, you could go ahead, although you'd do it in a spreadsheet or in a database, and you would rerun all those calculations for every single candle, but each time you go backwards, you would have to shift your look back period so that you always have 14 days each time you rerun the calculations. So you'd actually have to go back to the previous candle here when you were working out that one. And then you would plot the next value, which might be, say, 78, okay? And so on. So you plot these like this, and then the RSI line just connects all those RSI values, and there you have your RSI line, and that's how it's calculated. It's as simple as that. So now we understand how RSI is calculated, there are several useful insights that immediately pop out. And the first one is why RSI is plotted from a range of 0 at oversold up to a maximum 100 where the asset is overbought. Now, if you look at the formula, this actually makes a lot of sense, because let's imagine that price is pumping hard to the upside over those 14-day candle look back period, and let's say there are no downsides, no down days, only up days. Well, in that scenario, the average gain component of the formula would become a very large number, let's say infinity, and the average losses would be very low or close to 0, positive. So that means that the numerator is large, denominator small, so that would be a large number, infinity, and a large number plus 1 is also a large number. So 100 divided by a larger number, or infinity, goes down to almost nothing, or 0. So this whole part of this side of the equation becomes close or at 0. And 100 minus 0 equals 100. And intuitively, that makes sense, because if price is pumping hard to the upside and RSI is this kind of relative comparison of gains and losses and a measure of momentum, then you would expect RSI to have a high number and be towards the top of the range at 100. So that's why RSI is at the top. And then you just flip that around for when there are lots of losses, the RSI number tends to be down towards the 0 value. And this is why for any value between 0 and 30, we refer as RSI being oversold down here. And for any value between 70 and 100, we refer it as being in the overbought zone at the top here. The second insight is that RSI tends to be quite lagging and it reacts slowly to sudden price changes. So for example, this up candle here with a sharp, fast move upwards, due to the way that RSI calculates based on this 14-day moving average, even though there's a sharp move up, it doesn't have that much of an impact on the RSI line, because it takes a while for those increases to feed through in that moving average, which is why this RSI line is quite slow to react to those sharp price movements upwards. The third insight, and a common mistake, is that people try to buy when RSI first becomes oversold or sell when it first becomes overbought. But the problem here links back to our period of those 14 days, because let's say price has gone up sharply. Well, there's no reason price just can't continue for another 14 days or even longer. And all that will happen is you'll get a high RSI value when you get to here, and then RSI will just stay pinned up in the overbought zone for an extended period of time, weeks or possibly even months. So if you were trying to sell when RSI first arrives up here, let's say you sold here, well then you're going to be losing all the way up as you go along here, and vice versa when it's oversold. And lastly, while RSI is still useful, no indicator will be perfect. And the RSI, with its simplistic candle closes calculation, misses the volatility component, therefore it may not capture all the price action and movements. So if you have a doji candle where price actually moves up a lot and it moves down a lot, but the difference between the open and the close is small, well, that won't even be reflected in the RSI line. So because of these various different reasons, this is why we can look at stochastic RSI, which has a slightly more sophisticated calculation to overcome some of those issues. So what is the stochastic RSI? Well, high level, it's just a more sensitive and faster reacting momentum indicator developed by Chandy and Kroll in 1994. And stochastic RSI measures changes in the RSI rather than the underlying price, i.e. it's a second derivative. So stochastic RSI takes into account the relative highs and lows of regular RSI, and it transforms it so it can capture smaller oscillations in the underlying price. It's displayed as a blue and orange oscillating line, also from 0 to 1, with the percentage K fast and percentage D slow lines that represent smooth versions of the stochastic RSI raw values in each period and its moving average. This percentage K and percentage D smooth lines allow traders to identify trends and potential reversal points with more stability and less noise than using the raw values alone. So let's jump back onto the whiteboard and I'll show how the stochastic RSI links back to the regular RSI so this all makes sense. Although, if you just want to start using this, feel free to jump to the next section in the chapters below, where I will give my trading strategies. So, to calculate the stochastic RSI, it's a simple matter of taking the regular RSI and plugging it in the formula. And we can use the RSI numbers from the previous example, which I've put in here. So, the current RSI for this candle here is 75. The minimum RSI is the minimum RSI number in this range across all those 14 candles. And in this case, that'd be this one here, which has an RSI value of 24. So the minimum RSI is 24. And similarly, the maximum RSI is this one here, which is the highest RSI number of 78. So max RSI is 78. Then now we can calculate the raw stochastic RSI value here using that formula. So if we plug that in, current RSI is 75 minus minimum RSI 24 divided by maximum RSI 78 minus minimum RSI 24 again, multiplied by 100%. Now, if you calculate this through, that is equal to 51 over 54 times 100%, which equals 94.4%. So our raw StochRSI value for that candle is 94.4. Okay, so I've just put on the raw StochRSI values for the last 3 periods to show how to calculate percentage K, which is just the simple 3-period moving average. So for that, we just add up the last 3 periods of the raw StochRSI and divide that by 3, and that comes out to a value of 91 for percentage K in that period there. And now I'll do the same to put on the last 3 periods of percentage K. So now you can finally calculate the percentage D values, which is just the 3-period moving average from K. So for percentage D here, we just add up the last 3 percentage K values and divide that by 3. And that comes out to 90.3 as the value for percentage D for this candle here. And lastly, to draw the StochRSI indicator, we don't actually plot those raw StochRSI values because the graph would be much too jagged and jerky and not useful. Instead, we plot on those smoothed percentage K and percentage D lines, which are normally in blue and orange, here on the StochRSI chart. So if I just draw those on, and essentially that's all there is to it. And the blue is the percentage K, or fast moving, and the orange is the percentage D, or slow moving. And that's how it works. So there are four main differences between the stochastic RSI versus the regular RSI we saw earlier, with the first difference being that the stochastic RSI will react much more quickly to any sudden or fast price changes. And you can see that in the gradient of the stochastic RSI line, because here the regular RSI moves up gradually, whereas the stochastic RSI moves up much more quickly. The second advantage with stochastic RSI is that with those percentage K and percentage D moving average lines, this can provide us with an early warning there might be a reversal in price coming soon. Because the slower percentage K blue line will cross from underneath the slower percentage D line, and at that point, that's when the reversal is starting to happen. The third benefit is that due to stochastic RSI's faster reacting nature, it can give us more signals and trade opportunities and detect extra divergences compared to the regular RSI. Because you can see it oscillating much more frequently than the regular RSI. And the last point to note is that stochastic RSI does have slightly different levels for those overbought and oversold zones. With stochastic RSI, overbought is anything over 80 instead of 70, and oversold is anything below 20 instead of 30. Now that we understand the pros and cons of regular RSI versus stochastic RSI, I've invited two guests onto the show to share how they use this in their trading strategies to make money. And my first guest is a friend who has his own trading company called JayBird Trading. And his first tactic is he uses that 50 line on the regular RSI to help give a long or short bias and indicate whether the bulls or the bears are in control of the price action.
What I like to basically refer these lines to as anything 50 and above, that's the bullish control zone, meaning the bulls have taken control of price action and they're pushing it to the upside. And vice versa, once we break the 50 line and start trading below it, the bears have taken control and we are now in the bearish control zone.
The next key insight JayBird shares is what he calls the runaway train. And this is when RSI becomes very overbought or oversold, but rather than trying to play the reversal and get wrecked, you're actually trying to recognize when that's going to lead to a continuation.
Let's talk about when an asset becomes extremely overbought or extremely oversold. Now, a lot of things traders get wrong with the RSI is they simply think that just because we enter an overbought territory, that they should short it. And without confluence of being up against a very strong resistance level, this will get you absolutely wrecked. And how I like to refer this to is once the RSI breaks above the 70 line, if it doesn't immediately reject and come down, this is what I like to call the runaway train status. So basically what this is saying is the bulls are so strong here that it does not matter how overbought this asset is. they're going to continue to push price up until you finally get to a point where you get to a very large resistance level and you start forming bearish divergences on your daily, your 3-day, and your weekly.
The next regular RSI strategy is using those bullish or bearish divergences on the higher time frame to find good reversal trades, and then adding further confluence when the RSI line dips back below the 70 or back above that 30 line.
So if anybody doesn't understand or know how to actually see what a divergence is, what you're looking for is you're looking for price to be making a higher high, like this one here. So there's your higher high. And then you're going to be looking for the RSI to be making lower lows. So basically think of this as jaws, like alligator jaws opening up. And the stronger this gets, the stronger the rejection from it will be. So as you can see here, this impulse kept going up stronger and stronger until we finally got to a point where we created bearish divergence on the daily. We broke below the 70 line and we came back down for a good correction. So that's how to understand divergences and also what most traders get wrong with the RSI. And also conversely, it happens with the oversold. Not as much as the overbought though. Overbought readings, once they're in an impulse, they can go on for weeks, months, years without actually coming back down and correcting. So that's one thing that you really need to be careful for, depending on what time frame you're trading when you start shorting an asset. But as you get into the oversold territory, once you hit oversold, those bounces from those areas are usually a lot more higher percentage of a trade opposed to just shorting an asset that is an impulse to the upside. So now that we've explained what the bearish divergence is, let's find a bullish divergence. So as you can see right now on the daily time frame, we have one right here. So let's grab our line. And what we see here is where the RSI was bottomed out and oversold here. Price came down again, but the RSI made a higher high, and that is our bullish divergence. So as you can see, we are getting a slight bounce from it, but what is happening? We are coming up to the neutral area, which is what? The control zone. So what we're expecting to happen here is either bulls are going to step in, they're going to push us back into the bullish control zone, and we are going to get an impulse to the upside, or bears are going to step in and we're going to create a hidden bearish divergence, reject the 50 line, and then we're going to come back down.
To hit even better gains, JayBird outlines how he uses the stochastic RSI to provide further confluence to those regular RSI signals. And more specifically, he looks for 4 patterns with those percentage K and D lines. And they are when the lines cross each other, if there are any additional divergence signals on the stochastics, looking for when the lines come back from the overbought or oversold extremes back towards the middle and cross those 20 or 80 levels. And lastly, whether or not the stochastic RSI line actually gets held up and prevented from even entering the overbought or oversold zones. But I'll let him demonstrate how he actually does this.
Now, if we open up the stochastic RSI, and what we're looking for here is we're looking for 2 things. We're looking for the fast moving line to cross the slow moving line. And what that means is basically momentum, whichever way it's going, is starting to shift the other way. The second thing that we're looking for here is we're looking for these lines to either get up, both of them to get up over the 80 line into the overbought territory, or we're looking for them to both go below the 20 line into the oversold level. We're then looking for them to cross, either create a divergence or close it back above the 20 line or back below the 80 line. And then that will give us confidence knowing that the momentum has shifted in that direction. So if we go back to our chart here, and we go back to our divergence that we found here, we'll put that on. So we knew that price was at a resistance level here. We knew that we created bearish divergence on our RSI, and we're on the daily time frame, so that's a very powerful signal. And what did we notice here? We noticed that the second that the slow line got into overbought territory, you had a sharp spike down of the fast line, and both of them closed below the 80 line. So that told us that this bearish divergence is going to play out. That shifted momentum of the asset to the downside, basically saying the bears have taken control of price action right here at the control zone. So we knew that we were going to have to come down to either oversold territory, get a bounce, and then create a divergence. So now that that's where we're at, and we've created this bullish divergence, which is also a very powerful signal on the daily time frame, to add confluence to it, we have also created a bullish divergence on the stochastic RSI. Now, what do you notice about what happened here? The lines came down, but they did not get into oversold territory. The bulls took advantage of this divergence, stepped in, and they were able to push price up. And that's why we got our cross on our fast line over our slow line before this got into the oversold territory. So this is a very, very good example showing that you just simply cannot go long on an asset or short on an asset when they enter the overbought or oversold territories unless you have confluence of they're on a support level with divergence, with added confluence of momentum of our stochastic RSI, showing that the bulls are stepping in.
And for my second guest, Stutube Trading has kindly offered to come back on the show and talk about how he uses RSI. And he starts off with a great example of showing how to correctly recognize, particularly on higher time frames, when we're in a strong trend, and even though it can be overbought or oversold, this can just lead to more continuation.
Quite often people misunderstand the RSI. The RSI is fairly beginner friendly, except that makes it dangerous because it's easy for beginners to make a critical mistake. And that's misunderstanding the whole overbought and oversold theory, although that's what that can mean. However, if you're actually playing with the trend, remember the name of this indicator is the relative strength index. So it's showing you the strength, right? So in this example, obviously on the weekly chart, when we zoom way out and bring up the logarithmic chart here, a very obvious uptrend. And since it's such a strong uptrend, I'm not necessarily considering things overbought when the RSI is above that 70 level, because realistically, look at pretty much every bull market. It really gets going when the indicator starts basically hitting those conditions, right? Back here, where did we get that? So like down in this level, same with over here, even on this market cycle, right? So even though it's hitting those overextended conditions, not necessarily claiming that it's the end of the run. And again, that's because we're in a very strong uptrend in the overall lifespan of Bitcoin. So those conditions just generally mean that there's quite a lot of buying strength.
Next, Stu gives an absolute textbook example of how to start pulling all the powerful tools together and find confluence between market structure, the Fibonacci retracement levels, and those RSI divergences.
It's more so when we get these divergences that I have a problem, and basically looking at it as a bit of a reversal signal. Now, I'm always a big fan of using market structure first and looking for trade setups and then using indicators for confluence. And this is one of my favorite signals when I am looking for confluence and things like double tops. A lot of you guys know that I love pointing out Fibonacci levels. The 786, 886 are my favorite. So, but generally speaking, that's kind of near that double top area, right? So I'm going to talk about this in a second. Just looking at this first one on the 1 hour, this setup, I never did take a long based on this. So you can see that we have the overextended, oversold conditions on the 1 hour here, up to that 30 level and getting that very specific bullish divergence there. That's what I'd be looking for from a bullish perspective, but I never had, I was actually looking for a pullback to that 786, 886, and we never did even come down there. So I never actually got near my my preferred entry basically. But that was a very nice reversal signal until on the opposite end, you can see that we went, overextended, overbought conditions. And this is one that I did take serious because I was already quite bearish on a weekly chart, which I'm going to show you in a sec here. Everyone on social media got very bullish. We got this double top, very specific bearish divergence. Now, basically what I'm looking at is, and you can look at this in two ways. One, you can look at this as a perfect double top, or you can look at it as a pullback to that 786, 886 fib pocket. Either way, very tight invalidation as far as, a potential reversal play there. So as I was already bearish on the market, I was looking for a reason to take that swing basically. So just confirmed with that RSI. So beautiful position there. The reason why I was bearish in general is because I had that same signal on the weekly chart. I was warning for quite a while that I thought the market was getting bearish because, again, looking at market structure first, I have this little red horizontal trend line here. We lost this support level. And then basically I'm looking for a pullback to my fibs again, right? So I pull a Fibonacci this way, came right up to that 786, 886, and we get that RSI divergence. Again, I was one of the people calling for all-time highs just, about 4 weeks ago. But as soon as I noticed this signal and where we pulled back to, if this was a shorter time frame, I love shorting that signal. That's my favorite short signal. It's possible it already played out at this point, but either way, this was, a 25% move to the downside. So a very serious correction signaled by that, right? So it's not so much that the RSI went overbought. It's the fact that we got that bearish divergence and getting rejected at the 70 level. So basically what this is showing me is that we pretty much came right back up towards all-time high resistance, but we came at it with significantly less buying pressure, right? Because the relative strength was down quite drastically. So coming up to that same price level with a lot less strength, there was just no reason for me to be bullish at that point. So now we're going to have to see, maybe we can get some sort of a breakout on the RSI trend line, but we're going to have to see, right? That being said, looking for profits, if this would have just continued dumping, let's say we never found support at this level, let's just say we ended up continuing dumping to the downside and the RSI gets towards those, that 30 level, which in theory is oversold conditions. I would take that quite serious because, again, when you really zoom out, we are in an uptrend. And if we get back down to those oversold conditions, since the trend is to the upside, I am considering oversold to be oversold. But that's just kind of the same with, if I was looking at it on the opposite end, when we were in a very bearish downtrend, as we get into those oversold conditions, since it was such an aggressive downtrend here, I wasn't bullish at these levels just because the trend was to the downside. So I was just seeing this as a lot of strength, actually.
Lastly, Stu delivers the goods again here. He shows how he called the recent bottom on Bitcoin with a 4-hour trade setup that led to a 17% gain on a single trade, and even showing when to take profits using the RSI.
More recently, this is a 4-hour setup that I had looked at in the Discord. I had pointed out that, since we did get this nice little relief rally, although we got shut down at lower high resistance here on the 4-hour, As we were pulling back towards this support level to retest it, I started looking for the 786, 886 fib pocket. And because the RSI was showing significantly more strength than last time we were down at these levels. So I had made a note to basically watch for that 786 test as we get that bullish divergence. And I can even delete this dotted line so you can see it more clearly. Look how bang on that ended up being, because as we approach those levels with significantly more buy pressure, that was just a signal for me to go long. So that's basically the main way that I like to use this indicator. As we approach those overextended conditions, if I am in a trade going that direction, I am likely to start at least taking profits, because there's a chance that it's overextended, right? Just that with the trend, it's on its own, it's not necessarily a strong signal. So I just wanted to clear that up because it can be easily misunderstood. But anyways, hopefully you guys found this little clip useful. That's my take on the RSI. Stay safe, my friends. Peace.
4, 3, 2, 1.
Thanks, Stu. Some fantastic trade examples there of using the RSI. And hopefully you're starting to get a much deeper understanding of how RSI works. So now we can jump back and look at the TrendMaster Oscillator, which I've loaded here. And if I open up the RSI and StochRSI, you can see that it is providing signals at similar times. Like, for example, when Bitcoin recently bottomed out around 54,000 here, the RSI was calling that oversold signal. And then the StochRSI gave us an early warning momentum was shifting and we were going to get that bounce. Well, you can see the similar signal was flashing on the Harmony Oscillator from TrendMaster. But what I really like about their tool is that the Harmony Oscillator is combining 10 indicators all together, including RSI and all the other ones we saw earlier. So this just gives you much more confluence and confidence in, following that momentum with your trade setups. Another advantage is due to the way it harmonizes the signals across those 10 indicators, it helps to further reduce any false positives you might get by only looking at the RSI. If you would like to learn more about momentum trading, then hit that subscribe button and notification bell down below, because next week I'll be doing a follow-up episode on the TrendMaster Harmony Oscillator and looking at ways to improve your swing trading and even scalping with that powerful tool. Otherwise, I hope you've gotten value out of this video. And for the rest of today, I'm going to go and have a kickabout, put a steak on the barbie, and enjoy my Sunday afternoon. And I hope you do too. See you later.